Warren Buffett, the greatest investor alive, just did something he's never done before. In late 2024, he converted a massive chunk of his stock portfolio into cash. Berkshire Hathaway now sits on $325 billion in cash, the largest hoard in company history. But this isn't conservative investing. This is a warning signal. Because every time in history when elite investors have hoarded cash like this, a market crash followed. 1929, right before the Great Depression, insiders quietly moved to cash while regular people kept buying stocks. 2000, before the dot-com crash, smart money went to cash while retail investors lost everything. 2008, the same pattern, elite cash hoarding before the housing collapse. And here's what should terrify you. Right now, the total US stock market is worth over 200% of our entire economy, the highest level in history. When the Oracle of Omaha builds a $300 billion cash fortress, he's not waiting for opportunity. He's preparing for financial war. Subscribe, because when this market breaks, you'll want to understand exactly how the system was designed to transfer your wealth to people like Buffett, who saw it coming. In late 2024, Warren Buffett executed a financial maneuver that sent shockwaves through the investment community, though mainstream media largely buried the story beneath routine market commentary. The legendary investor, widely regarded as the greatest capital allocator of the modern era, abruptly converted a substantial portion of his equity portfolio into cash. Berkshire Hathaway reported cash holdings of approximately $325.2 billion, representing the largest cash accumulation in the company's 60-year history. This wasn't a gradual build-up of reserves or a temporary tactical adjustment. This was a dramatic strategic pivot that fundamentally contradicted everything Buffett had preached about long-term equity ownership and the futility of market timing. The significance of this move extends far beyond portfolio management. For decades, retail investors have viewed Buffett's buy-and-hold philosophy as an implicit endorsement of American economic strength and stock market stability. His famous pronouncements about never betting against America and the futility of trying to time market peaks and valleys became gospel for millions of individual investors. Yet, his massive cash accumulation directly contradicts this narrative, creating a cognitive dissonance that financial commentators have worked over time to rationalize. They frame the move as conservative prudence, strategic patience while waiting for attractive opportunities, or tax-efficient positioning ahead of potential policy changes. Few analysts dare to examine what such an enormous cash hoard actually signals about systemic market risk and the fundamental mispricing of assets across the entire financial system. This dramatic shift occurs against a backdrop that makes Buffett's behavior not just notable, but potentially prophetic. The aggregate United States stock market now trades at historically extreme valuations relative to the size of the underlying economy, as measured by the metric that bears his own name. The Buffett indicator, which compares total market capitalization to gross domestic product, currently registers readings that have preceded every major market collapse of the past century. When the total value of all publicly traded companies dramatically exceeds the productive capacity of the entire national economy, it signals that stock prices reflect speculation and financial engineering rather than genuine wealth creation. Yet, despite these warning signals flashing red across every historical precedent, the financial establishment continues promoting the narrative that elevated valuations represent a new normal justified by technological innovation and monetary accommodation. The thesis emerging from this analysis reveals that Buffett's cash accumulation represents far more than tactical portfolio management. It constitutes a warning flare shot across the bow of the financial system by someone with unparalleled access to corporate America and intimate knowledge of how markets actually function behind the public facade. This behavior mirrors the historically consistent pattern of elite capital withdrawal that precedes major economic retrenchments. When insiders with privileged information begin systematically extracting liquidity from inflated asset markets, they signal their belief that current valuations represent a dangerous disconnect from underlying economic reality. The cash hoard doesn't represent waiting for opportunity. It represents preparation for wealth transfer on a massive scale, positioning to acquire distressed assets at deep discounts after the inevitable correction destroys the portfolios of those who believed the system was designed to reward patient, long-term investors. This systematic examination of overvaluation, monetary distortion, and elite capital flows reveals the structural fragility concealed beneath bullish headlines and rosy economic projections, exposing how financial markets have become vehicles for wealth extraction rather than capital formation. The Buffett indicator represents one of the most revealing yet deliberately obscured metrics in modern finance, providing a stark measurement of how far stock market valuations have disconnected from the underlying productive capacity of the American economy. This deceptively simple calculation divides the total market capitalization of all publicly listed United States companies by the nation's gross domestic product, creating a ratio that functions essentially as a national price-to-sales multiple. The indicator typically uses the Wilshire 5000 Total Market Index as a proxy for total market capitalization, capturing the E value of virtually every publicly traded company in America, from massive multinational corporations down to small regional businesses. When this aggregate market value is compared against the total economic output measured by gross domestic product, the resulting percentage reveals whether stock prices reflect genuine wealth creation or speculative excess detached from economic reality. The historical context of this metric exposes a consistent pattern that financial institutions prefer to downplay or ignore entirely. Throughout the 20th century, when the market capitalization to gross domestic product ratio hovered between 60 and 80%, stock valuations generally aligned with underlying economic fundamentals, leaving room for sustainable growth as companies expanded their operations and increased their productive capacity. During these periods of rational valuation, patient investors could reasonably expect returns that reflected genuine increases in corporate earnings and economic expansion. However, when this ratio began climbing substantially above 100%, history demonstrates an almost inevitable pattern of mean reversion through major market corrections, bear markets, or broader economic contractions. The mechanism driving this reversion stems from the mathematical impossibility of stock values growing indefinitely faster than the real economy that supposedly supports them. As of mid-2025, the total market capitalization of United States equities reaches approximately $65 to $68 trillion, while nominal gross domestic product sits around $30 trillion. This calculation places the Buffett indicator north of 200 to 220%, representing valuations that dwarf any sustainable relationship between stock prices and economic output. To understand the magnitude of this distortion, consider that stock market values now exceed the entire productive capacity of the American economy by more than double, meaning that investors are collectively paying more than $2 for every dollar of actual economic activity. This represents not just overvaluation, but a fundamental break from any rational connection between asset prices and the businesses they supposedly represent. The interpretation of such extreme readings reveals the deliberate mechanisms through which wealth gets systematically transferred from ordinary investors to financial insiders. When the Buffett indicator reaches these historically unprecedented levels, it signals that stock valuations reflect not underlying real economic output, but rather speculation, financial engineering, and artificially inflated expectations propped up by monetary manipulation and debt expansion. Corporate buybacks, funded by cheap debt, private equity leveraged buyouts that extract value rather than create it, and speculative trading driven by algorithmic systems all contribute to pushing market values far beyond any connection to productive economic activity. The financial establishment dismisses these warning signals by invoking concepts like the new normal, permanent low interest rate environments, or revolutionary technological productivity gains. Yet these explanations consistently prove to be rationalizations for unsustainable asset bubbles rather than genuine economic transformation. This extreme disconnect between market valuations and economic reality creates the conditions for massive wealth transfer events, where those positioned in cash can acquire distressed assets at deep discounts, while ordinary investors who trusted the system watch their portfolios evaporate. The magnitude of Berkshire Hathaway's cash accumulation in 2024 and 2025 represents far more than conservative portfolio management or temporary market caution. The company's liquid reserves swelled to $325 billion, a sum that exceeds the gross domestic product of most developed nations and represents more than 10 times the minimal cash cushion that Buffett once claimed his company required for operational purposes. To comprehend the scale of this financial fortress, consider that this single cash position could purchase every publicly traded company in entire market sectors, acquire the majority of outstanding government debt from smaller nations, or fund the complete reconstruction of major metropolitan areas. This isn't prudent liquidity management. This is the systematic conversion of productive assets into defensive positioning on a scale that suggests preparation for economic warfare. The strategic implications of such massive cash hoarding reveal a fundamental breakdown in confidence regarding the pricing mechanism of both public and private assets across the entire financial system. For a firm that built its legendary reputation on deploying capital efficiently, identifying undervalued companies, executing transformative acquisitions, and compounding shareholder wealth through active investment, holding such enormous sums in cash equivalent signals that management believes there are no reasonably priced investment opportunities remaining in the marketplace. When the world's most successful value investor cannot find attractive assets to purchase, despite having unprecedented resources at his disposal, it indicates that asset prices have become so distorted by artificial liquidity and speculative excess that even premium businesses trade at valuations that make no economic sense. The mechanics behind this cash accumulation reveal deliberate divestiture of major equity positions that Berkshire had held for years or decades. Throughout the preceding quarters, Buffett orchestrated massive sales of high-profile holdings, including Apple Incorporated and Bank of America, two positions that represented cornerstones of the Berkshire portfolio and comprised billions of dollars in market value. These weren't minor portfolio adjustments or profit-taking exercises. These were wholesale exits from companies that remained profitable, well-managed, and dominant in their respective industries. The decision to liquidate such substantial stakes in blue-chip American corporations, while those companies continue generating strong earnings and maintaining competitive advantages, suggests that management recognized these stocks had become priced for perfection in ways that made continued ownership financially imprudent. The hidden mechanism operating beneath these portfolio moves involves the systematic withdrawal of liquidity from the price-inflating cycle that has driven asset values to historically unprecedented levels. When major institutional holders convert equity positions to cash, they effectively remove buying pressure from the market, while simultaneously creating selling pressure that can exert downward force on valuations. This process becomes self-reinforcing as other sophisticated investors recognize the signal and begin implementing similar defensive strategies. For insiders with deep market knowledge and extensive networks of information, converting to cash preserves optionality while positioning for maximum strategic advantage when market conditions inevitably normalize through correction or collapse. This defensive posturing represents the rational response of elite capital to market conditions that have become fundamentally unstable and unsustainable. By maintaining enormous cash reserves, sophisticated investors prepare to capitalize on the forced liquidations, distressed sales, and panic-driven selling that historically accompany major market corrections. The cash hoard functions as accumulated purchasing power that can be deployed when asset prices return to levels that reflect underlying economic fundamentals, rather than speculative excess and monetary manipulation. The deliberate monetary engineering orchestrated by central banking systems over recent decades represents one of the most sophisticated wealth transfer mechanisms ever deployed against ordinary savers and productive economic activity. The Federal Reserve, along with other major central banks, has systematically pumped unprecedented quantities of liquidity into the financial system through artificially suppressed interest rates, quantitative easing programs that purchase government and corporate bonds directly from primary dealers, and coordinated fiscal stimulus packages that inject newly created money into economic circulation. This monetary expansion operates on a scale that dwarfs historical precedent, with the Federal Reserve's balance sheet expanding from less than $1 trillion in 2007 to over $8 trillion by 2021, representing a creation of money supply that has no relationship to underlying economic growth or productive capacity expansion. The critical mechanism driving asset price inflation lies in how this artificially created liquidity gets distributed throughout the economic system, following predictable channels that systematically favor financial assets over productive investment. Rather than flowing evenly into wages, infrastructure development, research and development, or manufacturing capacity expansion, the overwhelming majority of newly created money moves directly into asset markets, including stocks, bonds, real estate, and speculative investments. This occurs because financial institutions, primary dealers, and sophisticated investors receive preferential access to cheap money through established relationships with central banks and government agencies, while ordinary businesses and individual savers face higher borrowing costs and reduced purchasing power through hidden inflation. The result creates a dual economy, where asset holders benefit from artificially inflated valuations, while productive economic sectors struggle with genuine capital formation and sustainable growth. Corporate management teams and financial institutions exploit these distorted monetary conditions through systematic debt-financed financial engineering that prioritizes short-term stock price appreciation over long-term business development. Companies borrow at artificially low interest rates to fund massive stock buyback programs that reduce share counts and mechanically increase earnings per share without improving underlying business performance. Private equity firms leverage cheap debt to acquire established companies, extract value through dividend recapitalizations and cost-cutting measures, then resell inflated assets to pension funds and institutional investors seeking yield in a zero-interest rate environment. This process inflates corporate valuations and market capitalizations without corresponding improvements in productivity, innovation, or economic output, creating the mathematical impossibility of sustainable returns based on genuine wealth creation. The wealth extraction mechanism operates by systematically transferring purchasing power from savers whose cash holdings lose value through currency debasement and suppressed interest rates to asset holders who benefit from inflated valuations across stocks, bonds, and real estate. Ordinary citizens who maintain savings accounts, certificates of deposit, or government bonds find their real wealth eroded by inflation rates that exceed their nominal returns, while those with access to leveraged investments, stock portfolios, and real estate holdings capture the artificial appreciation created by monetary expansion. This process concentrates wealth among those who already possess substantial asset holdings, while impoverishing wage earners and conservative savers who lack the knowledge, connections, or resources to participate in speculative asset markets. The bubble becomes self-reinforcing through momentum effects and psychological feedback loops that attract increasing amounts of capital into overvalued assets until sophisticated insiders recognize unsustainable conditions and begin systematic wealth preservation strategies. As asset prices continue rising, speculation intensifies, debt accumulation accelerates, and valuations stretch further beyond any rational relationship to underlying economic fundamentals. However, elite capital, with superior information networks and historical perspective, recognizes when these conditions approach critical thresholds and implements defensive positioning such as Buffett's massive cash accumulation, preparing to capitalize on the inevitable correction while ordinary investors remain trapped in overvalued positions. The historical pattern of elite capital withdrawal preceding major market collapses reveals a consistent sequence that is repeated across multiple centuries and economic systems, demonstrating that sophisticated investors with insider knowledge systematically recognize and prepare for systemic breakdown before ordinary investors comprehend the approaching danger. During the late 1920s, as the United States stock market roared far ahead of real industrial output and productive capacity, a speculative frenzy, fueled by unprecedented credit expansion and margin buying, created valuations that bore no relationship to underlying corporate earnings or economic fundamentals. The Federal Reserve had maintained artificially low interest rates throughout much of the decade, encouraging borrowing for speculative purposes while a flood of new retail investors entered the market, convinced they were participating in a permanent new era of prosperity. However, beneath the public euphoria, a select group of insiders, including Bernard Baruch, Joseph Kennedy, and other connected financiers, quietly began reducing their equity exposure and converting positions to cash during 1928 and early 1929, even as newspapers celebrated new market highs and economic commentators proclaimed that old valuation metrics no longer applied to the modern economy. When credit conditions eventually tightened and monetary policy shifted, the resulting crash wiped out millions of individual investors, while those who had positioned themselves defensively emerged with intact capital, ready to acquire distressed assets at deep discounts. The dot-com bubble of the late 1990s followed an identical pattern, with technology stocks pushing total market valuations to extremes relative to gross domestic product, while easy monetary policy and venture capital funding created an atmosphere of speculative excess that convinced ordinary investors they were witnessing a revolutionary transformation of economic fundamentals. Internet companies with no profits, minimal revenues, and business models based entirely on projected future growth commanded market capitalizations that exceeded established industrial corporations with decades of proven earnings. Yet, throughout 1999 and early 2000, institutional investors with value-oriented investment philosophies began systematically shifting portfolios toward cash positions and undervalued sectors, while retail investors continued pouring savings into technology mutual funds and individual dot-com stocks. When the Federal Reserve began raising interest rates and speculative funding dried up, the subsequent crash destroyed trillions in market capitalization, while sophisticated investors who had maintained defensive positioning acquired quality companies at severely discounted valuations. The 2007 to 2008 period preceding the global financial crisis demonstrated the same systematic elite exodus from inflated asset markets while ordinary investors remained committed to buy and hold strategies promoted by financial advisors and mainstream media. Real estate prices, securitized debt instruments, and equity valuations had been artificially inflated by loose monetary policies, subprime lending practices, and complex financial derivatives that obscured actual risk levels throughout the system. However, large institutional investors and hedge funds, with access to sophisticated analysis, began building cash reserves and implementing hedging strategies during 2006 and 2007, recognizing that housing prices had reached unsustainable levels and that credit markets had become dangerously over-leveraged. When the bubble finally burst, average investors suffered devastating portfolio losses and home equity destruction, while elite capital had preserved resources to capitalize on distressed opportunities. Each historical instance reveals the identical sequence of loose credit and monetary expansion, creating artificial asset price inflation, the systematic decoupling of market valuations from real economic growth, insider accumulation of cash and defensive positioning, inevitable crash or sharp correction, and massive wealth transfer from retail investors to elite holders who recognized the unsustainable nature of the bubble. The current 2025 environment aligns precisely with these historical patterns, suggesting that Buffett's cash accumulation represents not conservative prudence, but strategic preparation for the next phase of this recurring cycle. The convergence of extreme market valuations and elite capital withdrawal in late 2025 creates a financial landscape that mirrors the most dangerous periods in modern economic history, with total United States stock market valuation exceeding 200% of gross domestic product, while the world's most celebrated value investor has accumulated over $325 billion in cash reserves. This unprecedented combination signals not conservative portfolio management or temporary market caution, but rather systematic preparation for a wealth transfer event of extraordinary magnitude. The cash mountain that Berkshire Hathaway has constructed represents far more than defensive positioning. It constitutes a powder keg of accumulated purchasing power designed to be deployed when asset valuations collapse, enabling insiders to acquire distressed companies, real estate, and financial instruments at deep discounts, while ordinary investors who trusted the buy and hold until retirement narrative find themselves trapped on the wrong side of a coordinated wealth extraction operation. The mechanisms driving the approaching collapse operate through predictable but deliberately obscured channels that will systematically destroy the portfolios of those who believed the financial system was designed to reward patient long-term investing. As interest rates adjust to reflect actual risk levels and credit conditions tighten in response to over-leveraged corporate balance sheets, debt-laden companies across multiple sectors will face severe financial stress that triggers forced asset sales, margin calls, and cascading deleveraging throughout interconnected financial markets. This process accelerates as confidence evaporates, and momentum-driven investors who fueled the speculative bubble begin panic selling to preserve remaining capital. However, elite investors who position themselves in cash will not participate in this forced liquidation, instead maintaining their purchasing power while asset prices collapse around them. The resulting debt defaults, corporate bankruptcies, and real economy contraction will cascade beyond financial markets into unemployment, business failures, and long-term damage to productive economic capacity that destroys the retirement security and accumulated wealth of millions of Americans. For regular savers and ordinary retirement investors, this systematic collapse will erode not only stock portfolios and mutual fund holdings, but also pension systems, retirement accounts, and any wealth tied to inflated asset valuations that have been artificially supported by monetary manipulation and debt expansion. Meanwhile, those who attempt to preserve capital by converting to cash savings will find their purchasing power eroded by currency debasement and inflation, as central banks respond to the crisis with even more aggressive monetary expansion. This creates a deliberate trap where ordinary citizens cannot win regardless of their financial strategy, while elite capital, with superior information networks and defensive positioning, preserves and expands wealth through the crisis. The entire financial architecture reveals itself as a systematically rigged mechanism designed to enable elite wealth preservation and accumulation at the expense of productive economic activity and middle-class prosperity. Central bank monetary policies, debt-based expansion of money supply, capital market valuations divorced from economic reality, and insider capital flows all operate in coordination to facilitate periodic wealth transfers that concentrate resources among those with privileged access to information and sophisticated financial instruments. For average Americans, this system represents a permanent disadvantage where they consistently buy assets at inflated prices promoted by financial advisors and mainstream media, hold positions through devastating crashes while elite investors have already exited, and lose accumulated wealth that gets redistributed to those who understood the game being played against them. The fact that Warren Buffett has constructed the largest cash position in corporate history should not be dismissed as prudent conservatism, but recognized as an urgent warning that the most destructive phase of this wealth transfer cycle is approaching rapidly.